guys are just going to, look at it again in the final week of July. No, because if you're going to do that, I can guarantee you everything you've learned to now, you'll forget and then you'll fail. So that's not what you want. And then to try and, like right now, because you guys are a lot more calm, it's easier to learn, it's easier to understand. But obviously, when pressure starts mounting, then it becomes a little bit more difficult, right? So I've also inside those examples, I included, the prior period error part. The reason for that is because when it comes to prior period errors, those are actually not very dissimilar from your change in accounting policy. The note is very much the same. The principles are very much the same. The only thing that's really tricky is the correcting journal entries to guess and to get to the, period specific effects and the amounts for all of that. And those ones are a little bit more tricky. But what we're going to do for now is that we're going to look at the change in accounting estimates, okay? Because that is another one that you can get. And obviously, it's another section which I consider as, essentially free marks. To be honest, I don't consider this to be a very difficult section. So change in accounting policies, as with the previous one, I will give you guys the question, and you guys will be able to, refer back to this as well. So we're looking at question 9. Now today's class is just 1 hour because I've got management accounting after this, so I can't extend like how we extended last week. But we will be having supplementary classes as well, because remember, you guys are on a catch-up program. So you need to, I will be giving you guys additional material to get you guys to where you need to be, right? At this point in time, I'd say that you guys definitely are in a much better position than what you would have been in last week. It should be making a lot more sense. I think you guys should be a lot more grounded on the change in accounting policy, but I'm still going to give you guys more questions on change in accounting policy because I don't want you to forget. Repetition is key. Once you've done it, it sinks into your long-term memory. After that, it's just like you can recall this from. You won't even have to study the section. Okay. So before we continue, are there any questions on the change in accounting policy parts that you guys have? Anything on the change in accounting policy that's still troubling you, that's still unclear, that's still, a bit wishy-washy, that caused you a bit of problems in your homework before I move on? The thumbs up if you guys are fine. Otherwise, you can raise your hand and then I'll unmute you. Okay, that's good to know. Didn't anticipate there being too many questions. Emily, so you'll just follow basically on what we're doing, and please just work through the video again and then just try the class example that is up, and then see if you're able to come to the same solution and answers as what we came. And then, yeah, the sooner you can do that, the better, because I would ideally love it if you can be exactly where we are, by the time we've ended this, but, by the time we've ended the section, I mean, but, yeah. Okay, so let's read this question over here, right? So question 9 is 23 marks. And this is covering the change in accounting estimates. So let's start off reading the question like we did last week, right? So Solution Limited is a retailer of toys incorporated on the 1st of November 2000. So that's important to know as a date. On this date, it acquired the necessary equipment to commence its business operations. That's fine. After the annual financial statements for the year ended 30 April 2004, rather, right, had been prepared, the directors of Solution Limited decided to change the estimated residual value consisting of a computer server from null to 25,000 to reflect the increase in the standard of performance of its computer server. The details of the computer server as at the 30th of April 2003 are as follows: cost, accumulated depreciation, carrying amount, right? So remember what I told you, this is the year end last year. This is our current year end. This is the year end last year. It's the same as saying opening balance for the current year. So that's the note I would be making. That is what I'd just be, making an indication of over there, so that you just don't get confused, because it's very easy to mistake this and this. So, just underneath that, I'd write 1st May 2003, so that I know that, okay, this is now my opening balances. There's no confusion insofar as that is going to be concerned, right? No other computer server has been purchased or disposed of since Solution Limited commenced its business operations. Okay, so that's good for me to know, because then I don't have to keep track of too many movements during the year, and even in terms of depreciation. So yeah, it is the company's policy to depreciate computer servers rather, over its expected useful life of 5 years, according to the straight line method. SARS grants a Section 11E allowance on computer servers in terms of the Income Tax Act, allowing a 20% deduction per annum. And the Section 11E allowance is apportioned for a part of the year, right? This kind of information, your tax information, will always be given to you during your test or your exam, right? So they will tell you this. So this information has to be given to you, right? So it's not like you need to go and say, okay, well, all the modules we're studying, so this must be integrated with tax. So now I'm going to have to learn what the 11E allowances and all of that are. They will tell you this. Okay, so you don't need to overkill yourself, right? This could have just pretty much been additional information, right? It's not too complex. Then during the final audit of the annual financial statements for the year ended 30 April 2004, the auditors of Solution Limited determined that 25,000 of the accounts receivable on 30 April 2004 was not recoverable. The SARS, or the Revenue Service, has indicated that they will allow this credit loss as a deduction. The amount of the credit loss is insignificant. Okay. So this is another important one just to look at, because it is a credit loss that has now been incurred during the years. It's also, in other words, it's basically a bad debt written off. Okay. So this is something that needs to be adjusted for, but not for taxation purposes. So there's going to be a difference over here, right? So that's basically what that is telling us, right? The amount of the credit loss is insignificant, so that's fine. The profit before tax of Solution Limited for the years ended 30 April 2003 and 2004 amounted to 660 and 620 respectively, before providing for depreciation and the above mentioned items. So that's great. Okay, that's information. Remember what I told you, when they give you the profit before tax, this is information that you can literally just start off with. So in your calculations, your templates, etc., you're starting off with this. Remember, so it's half a mark, half a mark. Here's 1 mark for free. Okay, and then we'll start making all of our adjustments, but make sure that at least you've started off with these things and that you don't forget about including this. Okay. Solution proposed a dividend of 17,500 Rand on the 31st of May to all shareholders that were registered as at year end. Okay. And so the date is very important to keep an eye on. Okay. That is something just to take particular note of. Okay, because the date over here, as you can see, is falling outside of our current financial year. So this is why it's very, very important for you guys to keep close track of that, of what our reporting period is. After the board of directors of Solution Limited authorized the annual financial statements for the year ended, it was made available for the shareholders. So this basically is showing you that this is tying in with events after the reporting period, right? This is not what the question is testing, but it's good to be able to decipher that information. So you remember how last week I was always saying, write the standard that is applicable to the transaction next to the transaction, so that it gives you better context and background. So you'd write IS 10, IS 8, IS whatever. So that is what you need to be doing, so that you can see where you are linking it and how it's going to put in. Then deferred tax is provided on all temporary differences according to the statement of financial position approach, which is basically the approach that we used. Where you have your carrying amount, tax base, temporary difference. That's what's referred to as the statement of financial position approach. Okay, there are no other temporary differences except those mentioned in the question. Taxable profit will probably be available again, which deductible temporary differences can be utilized. So what is the significance of telling me this? That taxable profit will probably be available against which any deductible temporary differences can be utilized. Why do you guys think that that was mentioned in the question? Anybody want to guess? Like at least one response on this one. Am I going to have to pick a volunteer? Okay, but since you're saying that you came last, you can answer the question. Why do you think that sentence over here is significant? What is the point of telling me this?
Quite honestly, I'm really not sure.
Okay, well, at least that's an honest answer. Anyone else wants to assist? Or are you all unsure? Shocked emoji if you're unsure. Okay, please show the sentence again. So we go back here. This sentence of your taxable profit will probably be available in future against which deductible temporary differences can be utilized. Why is that relevant at all? What is the point of telling me something like this? You guys did do IS 12, if I'm correct. So yeah, you did. So that should have been given in there. No, doesn't have anything to do with going concern.
Sorry, sir.
Yeah.
Does it have anything to do with deferred tax?
It's linked to deferred tax, yeah. But exactly what relating to deferred tax? And this is where the theory is important, because this is like what with my other group of students. We did this in session 1, basically, where we saw when can you actually or why this is relevant. Okay, should I give you guys the answer to this? I think you guys okay. So this is an important principle, right? When it comes to your deferred tax, right? You guys know that when you can recognize the deferred tax liability, right? Let's say we have an asset, carrying amount of the asset is more than the tax base, that will give rise to a taxable temporary difference. You're giving rise to a deferred tax liability, right? What happens if we have the carrying amount being less than the tax base? That will give rise to a deferred tax asset, correct? Thumbs up if you follow me on that one. Right. So now, having said that, right, do you guys not remember in your studies of IS 12 that the deferred tax asset that you recognize must always be limited to the amount of future economic benefits that will be available against which that deferred tax asset can be utilized? Or rather, any future taxable profits that it can be utilized against. You guys remember that principle? So shocked emoji if it's the first time you're hearing that, or thumbs up if you do. Yes, as in first time you're hearing it, so yes, as in you remember that. Okay, so for Pussy Seaway, the first time. Okay, so Emily remembers. Okay, and then I'm assuming it's the same with. Okay. Okay, yeah, I remember. It's not sure how it applies. So whenever you're going to recognize a deferred tax asset, or when you have a deferred tax asset, you don't just automatically recognize it. That deferred tax asset is only recognized to the extent that it is probable that there will be future economic benefits or future taxable profit, rather, that will be available in future against which you can actually use this deferred tax asset against. Because you can only use a deferred tax asset against future economic benefits being profits, right? If you don't have future profits, you can't use the deferred tax assets. So it's basically like having an asset that you can't use. If you can't use it, then it doesn't really meet the principles of being recognized as an asset. So then you don't recognize the asset. That's basically what it means in a nutshell. Okay, you guys follow me on that one. Okay, so what we're going to do is we're going to start with the solution to this in the same way that we did it the last time, and I'm going to just work a little bit quicker than what I did the last time, because as I said, we need to pretty much finish by 10, and we will, but I want you guys to also try attempting this question. I will make it available to you guys on your own. It's not a very difficult one. The main thing with this is just understanding, again, the process, right? So what I would do is go to the required, always go to the required. What is the required? Say, prepare the statement of profit, loss, and other comprehensive income, and only the notes to the statement of profit or loss and other comprehensive income will be entered. Right. So this is simple because remember, this is a a change in accounting estimate. This does not generally affect the balance sheet that much. Okay. But the other one, remember, we had to prepare the everything, right? But with your change in estimates, you don't really have as much work, which is why I say this is an even simpler exercise to do. So we'll start off with the skeleton of the thing, right? So we'll say entity name Solution Limited. Of profits or loss and other comprehensive income for the year ended. I think it was 30 April 2004, right? 2004. Okay, and then we can just put this as 2004, 2003. Put Aryan out there. And then what did they start us off with? Our profit before tax. But we don't need to put that in over here, right? Because remember, there will still be adjustments and those kinds of things. So we don't start off with all of that. And remember, profit before tax is a note in itself to the financial statements because you do not have a profit before tax note. So we can just start this off and saying this is note 2, right? So profit before tax, income tax, expense, and then profit for the year, and then other comprehensive income, and then total comprehensive income for the year. Right, so that's simple enough. That's just your skeleton for now. I would say it's very good exam technique to do this because at the end of the day, at least you've got your stuff, sort of outlined, right? And then you know what it is that you need to pull in, right? Then we need to get to the notes, right? So Solution Limited notes to the financial statements for the year ended 30 April 2004. And then we'll start off with the notes that are relevant. So the first note that will be relevant would be our profits before tax note, and then we'll fill in everything else because it will be profit before tax as well as our income tax expense notes, right? Now we need to go into the third part, which is our calculations. Right. So now in starting off, right, where would you guys be starting off your calculation on this particular item or on this? Like if I had to ask you guys, change in accounting estimate, what would be the first thing that you'd be doing based on the information here? You know, if you guys have, I'll give you my approach and you guys tell me if, you know, you'd follow something different. But I would personally say, well, you know what? Let me start by looking at the whole deferred tax or the carrying amount of these the assets and calculating it up to the end of the year, because that is what we need to be determining, okay? And getting to the tax base of the asset. So the carrying amount of the asset as at the beginning of the year isn't too difficult to determine because that's already been given to us, right? What is a little bit more confusing, or which requires a bit more work, would be to determine the tax base, because remember, all of this information here was given to you, right? So remember, they've said that the policy is to depreciate, you know, the servers over their useful life, yada, 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 all of that stuff. So I would say, you know, it's good to show the calculation and the trace of the amounts from the inception of the asset going forward, because that gives you guys a full picture of what the assets, you know, the deferred tax on the asset is going to look like. So let me give you guys the example of this, right? So I would say the first calculation would be, let's say deferred tax on assets, right? Something like that. And then I'd start off with the amounts relating to the asset, right? So let's put that there. The costs, and you guys can choose your own approach. This is just, you know, what I would be doing. You know, you know, for your guys' purposes, I mean, you know, you can do whichever way is going to be easier for you to calculate the amounts, right? So the carrying amount as at when was the assets acquired? From the 1st of November 2000, right? So that means the first year end would have been 31, or rather 30 April 2001, right? So it's carrying amount 30 April 2001. Okay. Then we got depreciation again, and then carrying amount for April 2002. Depreciation again, carrying amount for the 30th of April 2003, and then depreciation again, and then this will be the carrying amount as at the 30th of April 2004, right? So I'm just doing everything as one calculation, but you guys can, you know, just do it separately, as the carrying amount separate and then the tax base separate, right? But I think it's just good exam technique just to do it this way. Then you'll say, okay, accounting. And then tax, right? So for accounting purposes, the cost of the asset is the same, right? The 500,000, there's no difference there. The 500,000, there's no difference there, right? Perfect. Depreciation on the assets, you need to show the calculation. So we go back to the calculation over here, or the information rather, 1st of November, right? So in November, December, January, February, March, April, that's 6 months. And how many years is it over? 5 years, right? The SARS is allowing a deduction 20% per annum, and it's apportioned for part of a year. So 5 years as well, because that's what 20% is. And it's apportioned for a part of a year, which works the same as depreciation. So if you look at it, like if we really now just do the calculation for our depreciation, right? I'm just doing it on Excel so that you guys can follow it easier, but let me just add a line, then I'll rather show the calculation. Okay. Your depreciation is going to be the 500,000 over 5 times 6 over 12, right? Which is going to be 50,000 from 500. Yeah, that'll be 50,000. Right. And then your taxation, your VNCA, that is going to be your 500,000 as well, times 20% times 6 over 12, which is going to give you the same thing over here, right? 50,000. Okay. And then this minus, go to this. Okay, because that's a negative, right? So that's giving me a carrying amount of 450. Okay. So let me go back to you guys. Are you guys following me so far? Nombulelo, you have a question?
The question doesn't say, does it say that we shouldn't apportion or we can apportion?
It says that you should apportion.
Oh, okay.
Yeah. So that's why we apportioned it that way, but that's why it's very important to read what it says, because they had the question said don't apportion. You would have gotten it. Well, look, let's say, for example, you apportioned it, but the question said don't apportion. You would have just lost it 1 mark there, but then you can still continue with your calculation, right? So your principal would have been wrong, but you'd only been penalized once. They wouldn't have penalized you right until the end. So the idea basically, or the principle is, whenever you're doing something, don't stop with your calculation. Just make sure that you always finish your calculations. Okay. So now we've done that, right? Now we can repeat that. Now, obviously, if this is for half a year, I mean, I'm not going to do the calculation, for each one, because I think then you guys know that obviously that is for 6 months and for 12 months, and this is going to be 100,000, right? So I think that is just easy to follow. And just going to do that plus that to get to the base of the calculation over there. And then this will be 100,000 as well. Okay. Okay, and it's equal to this plus this, just that. You can just drag and drop that, right? Now, here's the thing with the change in accounting estimate, right? Now, for tax purposes, SARS don't give a damn what we're doing. They work on their own thing for tax, right? So this will still stay the same. So you can complete this, right? So this will still be 100,000. Okay, it doesn't matter. Our change in accounting estimate and all that, SARS doesn't care at all about that. They don't give half a damn, right? So you can complete this column over here, right? So over here, we've got our tax base for the asset, which is what we have, right? As 150. Our depreciation for the year, this we cannot say is going to be the 100,000, because there was a change in estimates during the year, right? And this change in estimates during the year is now what we need to take into account for determining the carrying amount for accounting purposes, right? And what did it say? That the change in carrying amount is basically going to be the tax base was, I mean, not the tax base, rather the residual value was 0, and now it's gone to 25,000, right? So when you're doing a change in accounting estimate, right? When you're going to change your depreciation, the best way of doing this is always to say, when you're calculating your depreciation, is to say your carrying amounts, right? So maybe I'll just put this as calculation 2 to say depreciation on assets, right? And I'll say, what is my carrying amounts, right? Which is the 250, okay? So we got there the 250, 1 to 3. Then I will say, what is my residual value? This is a calculation that I do all the time anyway, right? Whether there's a change in residual value or not, right? So even if they didn't mention a change in residual value, I would have just had this as 0 then, right? But always have it as good exam technique, because I'll show you why. But let me just put this in first, right? Because remember, you don't depreciate on cost. You depreciate what? Your depreciable amount, right? You guys know that. Yeah, I can just put it like this. And then say it's equal to this minus that, which is 225,000, right? You depreciate your depreciable amount. You don't depreciate your cost. So always have this as your, whenever you're calculating depreciation, this is what your calculation should look like. If you don't have a residual value, then just put it as 0, right? Like that. And then, that's what your answer will be. But don't leave this out. I am not a fan of ignoring the residual value, right? If they say there's no residual value, it's a residual value of 0, but always have it as a habit to calculate that. Now, this is your remaining depreciable amount. So now you need to divide this by your remaining useful life. Right, so what is our remaining useful life, right? Our total useful life was 5 years, right? So 6 months went there, so it's 4.5 years. 1 year went here, it's 3.5 years. 1 year went there, it's 2.5 years. So the carrying amount as at this point is, the remaining useful life at this point is 2.5 years, right? So 2.5, and then depreciation for the year. Right, and that's going to be quite simply is equal to this divided by that, and that's going to be 90,000, right? So then we're going to say 90, and then is equal to this plus. Right, so that's the calculation for the change in accounting estimate done, right? We will still do the disclosure part, right? But we're not yet at that point, but that's basically it, right? And there's our corresponding calculation. So you've gotten marks for this, all of this, transferring that there, doing all of these calculations as well, because this wasn't given to you. You had to calculate it. Now we've got our carrying amount, we've got our tax base. Our temporary difference is going to be this minus that, which is 10,000 Rand. And then what is our deferred tax percentage? I think it was 28%. So is equal to this times 0.28, which is 2,800, and that is the deferred tax liability, right? So you guys are with me at that point. So, any questions up to this point? You're all fine. So I think, maybe one of the most complicated aspects would be the change in estimate part, right? Because where do you get started with the calculation? Like, why did I start here, right? So again, you don't need to start where I started. This is a guide, right? It's where I would, but the general principle is that you need to get to the carrying amount of your asset as at the end of the year, right, as the first step. So you could have just done this, for example, as its own step. You could have said, deferred carrying amount of asset as at the end of the year. You could have ignored this, and you could have just done this as one calculation. Then you could have done tax base as another, and then done your deferred tax, as a third calculation. But it's just time consuming, right, to do it that way, when the calculation is going to look the same. So that's why I've done it this way. And remember, if you think about it, they also sort of made the depreciation match the wear and tear, so that is one of the reasons that they've done that, just so that you can use one standard calculation. Your calculation is going to look the same, basically. The only thing that changed was because of the change in accounting estimate. Otherwise, we'd have no temporary difference at all. Okay, so that's the reason for, the way that I've done it, the way that I've done it. But if you guys are more comfortable doing it, like, more step by step, saying, no, I'm going to first determine the carrying amount of my asset, then I'll do something, then that's also up to you. In most cases, when you get a change in an estimate, it's going to be on an assets, right? It's going to be on a, item of PPE, or like, with your trade debtors, that kind of thing. Okay, but that is where, you would need to be, quite careful with your calculations, and just see that you at least put it out in a way that is easy for the market to follow. Now we have our depreciation. Remember, we have our profit before tax. So we'll say profit before tax is stated before the, or not before, but rather after the following amounts. And then we'd say, let's make this 2004, 2003. Start off with my depreciation. And what's my depreciation here? It's 90,000 Rand and 100,000, right? You get marks there already. Was there anything else in my profit before tax? It was just the credit losses. So we go to my credit losses. So I can just say, I'd take credit losses or bad debts, something like that. And we said it was 25,000 Rand. Right? Remember looking at the information in the question. It said something, where's it on? Over there, right? So that's it, right? So that's quite simple, not difficult, that easy, right? And that's our profit before tax. It's taking those items into consideration. Okay, so it's not hard to determine that. And now from there, obviously, we can calculate our profit before tax on the statement of financial position, statement of profit, loss, and other comprehensive income, which is going to be, what was it? The amount that they gave. So let's say if we want to calculate our profit before tax, we can say profit before tax, and then we say given depreciation, credit loss, yes, I'll just say this is 2004, this is 2003. Right, so what was the amount given? 660 and 620. So we've got 660, 620. And then what is my depreciation? 90,000 there. It was 100,000 there, 25,000 there, 240,000. And this was 0. And then we do our calculation is equal to that minus this, minus that, is giving me 545 and the 520. Okay, so that's basically how it'd be doing the profit before tax calculation, and then getting to that figure. Okay, so again, it's not really too untoward, or like I said, it's should be pretty straightforward to calculate the profit before tax. I don't think that should be giving you guys any headaches. That should be, well, actually, this should be the other way around, 620 and 660, right? So there should be 620. That should be 660. Okay, so that's correct, right? Yeah, so just make sure that you read the information, well, and don't make the mistake that I made. So this was 2004, that was 2003. I had it mixed up, right? So these are your final amounts, right? And this you can transfer now into your templates, right? So that will go there, and we can pull that. This is why I actually prefer it when you guys write on the laptop, because I feel like you can do this, so just makes it easier. Anyway, and this is your profit before tax note that's done. The next note will be your well, it's not actually done, because remember, your change in accounting policy can be done as part of your profit before tax, or it could be a separate note, but the convention is to keep it as part of your change in accounting policy. So you'll just say something like included in depreciation is a change in accounting estimate, rather, not policy. Yeah. And then you can give the details, right? Well, remember I said we can just copy and paste this from the question. So we would just say that, we could literally just state that, okay, that is like good enough to do, right? Because that information is given. So you could just rewrite all of that. I'm gonna have hell with this again now, not. So just emergent sensor, wrap text, and then to that. Okay, right. So that is just details relating to your change in accounting estimate that you would have included over there. And then you would state now what the effect of the change in accounting policy was. Okay. So then you'd say not accounting policy, the effect of the change in estimates is as follows, right? So remember, there will be a decrease in the amount of depreciation for the current year, right? So decrease in the amount of depreciation for the current year of 10,000 rand. And then you can say increase in the amounts of depreciation for future years. Because remember, you'll be depreciating it by 10,000 more in future periods, right? You've basically just deferred that depreciation in a manner of speaking. And that covers the change in the accounting estimates part. That's literally it, done. Okay, there's nothing more that you need to add to that. That's it. Okay, that's your change in accounting estimate done. The only thing that we haven't done is to be looking at the tax implication of this. So let me see how far we can get with the taxation calculation, right? So we can say start off with current tax expense. That's what I'd start off with, and I say profits before tax, which is given, and then I would say my tax allowance, because remember we had the tax allowance for the bad debts allowance that we had. Then we'd say credit losses for that. And then we'd say taxable income, right? So we'd start off with this again. Say it's equal to this, and then say this is equal to this. Right, now the tax allowance, this was relating to the make it clear, section 11E. Okay. So you take that 100,000 into account over there. 100,000. Remember, this was the wear and tear allowance. You only take the wear and tear into account, right? Then they said that SARS will allow the write-off as an allowance, right? It wasn't last year, but that other one was, right? The credit losses, right? So you take your depreciation into account. I mean, your depreciation allowance into account, and you take your wear and tear allowance into account, right? And I mean, not your wear and tear, your write-off of your bad debt, because SARS did allow it as a allowance for the current year, and then you just say it's equal to this plus this plus that. That's 495, and then that is going to give us 560, and then from our 560, I mean, then we just calculate our current tax expense at 28%. So it's equal to this times 0.28 is 138,600, and it's 11568. Okay, and this then we would put in our income tax expense notes. So we have an income tax expense note over here. We'd say, remember, income tax expense. We'd have current tax, and we'd have deferred tax, and then with our current tax, well, we've already calculated that, and then our deferred tax. So let's go to our current tax. Got these amounts over there, 136,8. And just copy and paste them. It's easier. Okay, and then our deferred tax, which has increased by, well, for the current year's balance, it was that 2,800. So we will go to that 2,800 and use that. I think it was 2,800, if I'm not mistaken. Okay, and then you have your income tax expense. Okay, so I'm not going to transfer all the amounts to the there, right? And then you'll transfer it onto your statement. So it's this equal to that's to that minus that. Okay. So that's basically it. Okay. This will be 0. That'll be 0. And that is equal to this plus that. And then that's your final answer, right? So let me go to you guys. You guys are way too quiet. Did you guys follow exactly step by step how you guys, well, that's my suggested approach, but how this thing needs to get tied up. I know with the taxation part, it gets confusing, and that's unfortunately going to be a trend. Right, the taxation aspect is always going to, but if you follow the step-by-step approach that I'm using, you're going to be earning marks until you get to the taxation. Notice I don't ever start with the tax. Even in the previous class, I didn't start with the tax. I did a lot of the other stuff first, and then I started looking at the tax effects of all of this. So here's the thing. Let's say that you did all of this, and let's say you even left the tax out, which is not what you should be aiming to do. But let's say you hit a blank in the question. You just, for the life of you, can't think what you need to do with the tax. At least in this way, you are able to score marks in your other sections and get some kind of, system going so that you are able to, pass the question at least. But in any event, your taxation needs to be the last thing that you do, because your taxation is just a product of your normal accounting. So that is where you need to always be, when you're looking at your sequence or your step-by-step approach, right? that you don't ever start off with the tax. You start off with the accounting, and then you look at the tax implications of the, accounting that you've done, and then you take it from there. But you always start with the accounting first. Even when we were calculating the assets carrying amount, remember we started off with the carrying amount of the asset, then we looked at the tax base. So you follow that whole thing. Always look at the accounting first, then you start looking. Even with the profit, right? We calculated our profit before tax was, then we looked at the income tax effect of all of this. Okay. Are there any questions that you guys have on what we've done? Okay, so that's good. Okay, so thumbs up if you guys are okay with it. If you guys are not okay with it or still trying to figure it out, then you can, okay, lots of thumbs up. So that's very good. That's very encouraging to see. You guys will get additional homework questions on this. The main thing I want you guys to do is I want you guys to be doing this like clockwork. You need to be doing it, over and over again. But you guys see how, based on the thing we did last week, the class there, that now if you follow that approach, it's sort of gelling all together. There is the step by step. Yes, Pusisiwe.
So I'm not sure if I remember the amount, the 17,500, the dividend. I'd just like to know, when would that be incorporated in our solution? Say, for instance, if they required something else.
Okay, so this would basically come as an event after the reporting period. So because that's what this relates to. See, look at the date, 31 May, and when is my financial statements, my year end date on which it's authorized for issue. So this date falls there. So that's the relevance of that. So this question was probably extracted from another question, and we just needed to look at the what they call it, the accounting estimate part. But you just, prepare a note that says events after the reporting dates, and then you just say, on 31 May, the company declared a dividend amounting to yada yada, and that's it. It wouldn't even come in your statement of changes in equity, because remember, your statement of changes in equity is only up to year end. You didn't have that obligation as year end. You didn't declare it then. Yes, Sophia, you have a question?
Yes, would it be possible to please share the question papers with us so we can print it out?
Yeah, I'm going to do that. I'm going to include that as a pack so that you guys can then work through it. And then I will give you guys solutions to this as well. But I want you guys to first do it. I don't want to give you guys the solutions now. I want you guys to do it. Even if you get it wrong, that's fine. This is the time to do it wrong, because I don't want any of you yesing it. And I was a student as well. I know you're going to yes it, but you need to get the whole mechanics of doing the question. And once you do it, you're going to see your time will improve and everything will improve as well. Okay. Right. Any further questions on, from you guys?